Welcome to Growth Investing Mastery. This video will look at discovering a new stock screener. As a reminder, this is not investment advice or recommendations to buy stocks. The purpose of this video is to examine a new stock screener we created. The screener looks for accelerating financials, and we'll take a look at how the screener was created. What makes this screener different is the new screener is based on analyst estimates for the next quarter. Typically, the screeners we use work with posted results from the most recent quarter, but the effectiveness of the screener has already been proven. We found a new company already with this screener, and it's yielded many promising names we would have not heard of otherwise. Let's talk about the motivation for this screener. We were checking in on our old friend SuperMicro with symbol SMCI. And the current quarter looked like a disaster. They had $5 billion in revenue in the quarter, but this was down 15% year over year and down sequentially as well. Additionally, EBITDA, net income, and gross margin were all the lowest the company had posted in the past year. I was curious how SuperMicro is performing so poorly. SuperMicro is a hardware manufacturer in the AI space. And many AI-related hardware names are doing really well, both business-wise and stock price-wise. I then went to their investor relations page and wanted to check their guidance. I was shocked to see the company is guiding for 10 to 11 billion of revenue next quarter. The guidance is for over a 100% increase quarter over quarter and over an 80% increase year over year. It definitely seemed like we should investigate this company again. This prompted me to think about how we could discover these types of opportunities. And I kept thinking about how the stock screeners I use look at the current quarter's results, rather than the guidance the company is giving. I thought it may be useful in this video to give a behind-the-scenes look at the data we are examining. The main data provider I use is called Koyfin. And here we're on the Financial Analysis tab for SuperMicro. And we have the last year of data for SuperMicro in front of us. The key metrics we care about are all listed here with revenue, gross margin, EBITDA, and net income. Over on the right, I highlighted the latest quarter of data with a red box. The first line there shows the revenue, which landed at $5 billion for the current quarter. And the next number below that is the year-over-year growth rate for revenue. We usually like to see the year-over-year growth rate for revenue be above 40% for a growth company we want to invest in. And you can see a problem right away. The year-over-year growth rate on this latest quarter is negative 15%. We can look all the way over on the left for the previous year's revenue, which was 5.9 billion, and that means it's sequentially down. Additionally, when we look at the pattern of revenue growth rate over the past year, it looks poorly. 1 year ago, revenue was growing 180% year over year. But then in the next quarter, the revenue growth rate year over year went to 55%. It then went to 19% and then to 8%. When we look at gross margin, 1 year ago, SuperMicro had a 13% gross margin, and now they have a 9% gross margin. 1 year ago, SuperMicro had 519 million of EBITDA, and in this latest quarter, they had only 195 million of EBITDA. Lastly, on net income, a year ago, they had 424 million of net income, and now it's at 168. So nearly every metric, even on a net basis, is down year over year. Normally, a company with these types of numbers is not even worth investigating, but we got curious. Here's a screenshot of the press release for SuperMicro's most recent earnings. It should be pretty easy to find this information on any company. You can go to Google and search for SuperMicro Investor Relations. For most companies, it should be pretty easy to find the press release on their latest earnings, but you might have to scroll back a few stories if they had more recent press releases. And it's definitely a yellow or a red flag for a company if you're having trouble tracking down what their results are on their investor relations page. At the top of this press release for SuperMicro, we see details of the metrics we talked about. For example, we see at the top that they had net sales or revenue of 5 billion versus 5.8 on the previous quarter and 5.9 billion a year ago. But all the way down at the bottom, they have this section called Business Outlook. It says the company expects net sales of 10 billion to 11 billion for the second quarter of fiscal year 2026, which is their next quarter. That stood out to me right away. Even if the company was guiding for 7 to 8 billion, it would still be a reasonable step up. But they're guiding to over 100% quarter over quarter growth. Going back into Koyfin, our data provider, we take a look at analyst estimates and what's under the actuals and consensus tab. It shows for the next quarter, the analyst consensus is for 10.3 billion of revenue. And the 10.3 is actually lower than the midpoint that the company guided for, which was 10 to 11 billion. A lot of the time, the analyst estimates are just lazy. They guess right in the middle of what the company is guiding for. So it's not a bold prediction typically. In the red box that's highlighted in the screenshot, we also see that year-over-year percentage change, which is 82% year-over-year. And under the quarter-over-quarter percentage change, we see it's 106%. These revenue step-ups look incredible, but we did notice a slightly yellow flag on this tab as well. We see that analysts expect adjusted EBITDA for the next quarter to be 441 million, and that's in comparison to 10.3 billion of revenue. When we look back on the far left 6 quarters ago, we see that revenue was 5.9 billion, but they had adjusted EBITDA of 587 million. So we definitely want to figure out the reason that profitability percentages are projected to go down. There's another tab in the Koyfin data provider which shows future quarter estimates overview. This allows us to view where the analysts expect the revenue to land at over the course of the next 2 years. And they also have tabs for looking at profitability metrics as well. There's some pretty interesting data here because it requires us to read between the lines. Analysts are projecting the next quarter to land at 10.3 billion, as we discussed. But the quarter after that, they're projecting 10.2 billion. So for the current analyst estimates, they're projecting a small sequential decline on the next quarter's guidance. The quarters following that are 10.7, 10.3, 11.4, 10.7, and 11.6 billion. So the analysts are basically projecting the run rate for the next 2 years of revenue. This means the analysts think the company will get about 10 or 11 billion for every quarter for the next 2 years. And you can already see how this might be a bit of lazy work on their side for these projections. But to be fair, it is hard to project how a company is going to be doing 2 years from now. And there's really 2 sides of the coin here. We could look at this and be concerned that analysts think the revenue is going to be flat over the next 2 years after they have this big step up. Or when we read between the lines, it's more likely that analysts haven't caught up to the new prospects for SuperMicro. The real opportunity comes here if SuperMicro is able to give strong guidance next quarter. For example, if SuperMicro lands at $11 billion of revenue next quarter, and they guide for 13 billion next quarter, it breaks the analyst model. All of a sudden, the analyst estimates where they had 10.2 billion 2 quarters from now will have to be moved up by approximately 2.8 billion. And that's just to keep in line with what the company is then guiding for. On the other hand, this could be a fluke quarter for SuperMicro, and if they give guidance of around 9 billion, the stock price is unlikely to rally. And after we eventually went through the transcript of SuperMicro, we do have some questions about where this revenue may land. The current quarter had 1.5 billion of sales slip into the next quarter, and that's part of the reason the guidance to 10 to 11 was so high. And that definitely makes us a little more cautious about being sure of the company raising guidance even further. After going through this process with SuperMicro, we had the idea for the new screener. The first thought was to look for companies where the quarter-over-quarter guidance is going up over 20%. But I was wondering how to do this because data providers don't have the official guidance. So I don't think there's any way in Koyfin to get that 10 to 11 billion of guidance that the company was giving. And the other data providers that I occasionally use don't offer that either. But maybe that is offered somewhere. I was originally thinking to code a custom solution to this problem as I used to be a programmer. My idea was to take the NASDAQ symbols and scrape guidance from the company websites. But this is a pretty messy solution, and each site has a different format for how they give the guidance. There's a lot of ways for this type of solution to break in practice. I started asking AI through Perplexity if there's a simple way to code this, or if there's a good API that might have this official company guidance. The AI mentioned we could use a proxy of analyst estimates to accomplish our goal here. And the way that analyst estimates work, where they guess within the company guidance, actually is really useful here. This is because the analyst estimates strongly correlate to what the company guided. I also asked AI if Koyfin has the percentage changes of analyst estimates in their screener. And we were really pleased to learn that Koyfin has quarter over quarter and year over year percentage changes for analyst estimates. So this means we don't have to code anything at all, which is good news. We started building our screener with just the one requirement of the 20% quarter over quarter increase with regard to analyst estimates. But we quickly learned this one requirement lets in companies that have a lot of seasonality. And we're currently going from Q3 to Q4 for most companies' results. Many companies have a particularly strong Q4, especially if they depend on the holiday season for their sales. This seasonality issue led us to add in the requirement for 40% year-over-year growth on the analyst estimates as well for revenue. This 40% year-over-year growth rate mimics our traditional screener, but it's now based on analyst estimates rather than the results of the current quarter. We were really pleased to find that this new screener scoops up SuperMicro as we expected, and it found plenty of new names we never heard of. That was really great news to see there's a lot of new names coming through this new screener. Here's how the new screener looks in Koyfin if you want to try setting this up at home. I've highlighted the two key fields here. The first being that the analyst estimates for revenue next quarter are for over 20% growth. The wording or abbreviation is a bit tricky here. It writes this as revenues est QOQ percent FQ1E. The second important requirement is for the analyst estimates on revenue to be going up over 40% year over year. And again, that one has a bit of a weird abbreviation. It's revenues est year over year percent FY1E. There's a few other minor criteria for this screen we need to add in. I put a very tiny market cap requirement of the company being $20 million or above. I also put in another requirement that the net change in revenue quarter over quarter has to be at least 2 million. And this was needed because sometimes a company would go from 0.1 million to 0.2 million quarter over quarter, and that counts as a 100% increase. But the revenue increase in net terms is only $100,000. And you may want to tinker a bit with these values and see what comes through. For example, you could change the year-over-year growth rate for analyst estimates to be greater than 30% rather than 40%. This will let in slightly more names, but of lower growth. Also, one point to note is that in the universe of securities selection at the top, we have primary security selected as yes. And this helps root out a couple things like Class A or Class B shares, and it helps keep out a couple other factors that can impact the screen. We have trading region listed as United States and Canada, and this will scoop up all the NASDAQ stocks and New York Stock Exchange stocks, along with the Canadian listed ones. I've also experimented removing that trading region and having the screener be completely international. This had a bunch of new names from overseas as well that looked pretty interesting. But usually we want to sort through those NASDAQ stocks first because technology stocks typically get listed there. Now let's discuss actually using this new screener and putting it in action. We want to remember that the screener is only the first step, and its main purpose is to surface new symbols and names we haven't seen before. I recommend sorting the resulting list from the screener by industry. This is often the best option to start with because we can examine top industries such as software and semiconductors, where we often find a lot of promising growth names. And if you've been looking at the list for a while and the name seems stale, you can also sort by different criteria. When we're considering other industries to look at, there's some secondary industries which sometimes have some promising names. These include consumer finance, communication equipment, electrical equipment, and IT services. But we want to avoid industries like metals and mining or real estate investment trusts. Usually in the industry of metals and mining, the companies grow through acquisition. So one gold miner may have extra cash and they decide to purchase a competitor. This can make the revenue growth rates look impressive for a miner. But the issue is they probably took debt or dilution to buy that other company. We strongly prefer companies which can grow through organic growth rather than acquisitions. A company which can grow organically often has the ability to innovate. Our next step with a screener, after sorting by industry, is to look for names we have not heard of or examined before. We can then open a separate tab in Koyfin to look at the company's financials and what the analyst estimates are. We can also ping AI tools to get a quick company overview. And we want to keep an open mind here, even if the idea or the company sounds pretty crazy on the surface. Assuming the financials and the idea of the company check out, then we want to print the transcript. This physical copy of the transcript acts as a forcing function for us to actually review the transcript in depth. A key takeaway here is the screener is only the start of the process. And it's a common mistake for more numbers-based investors to use the screen as an algorithmic way to determine if a company will make a good investment or not. Here's a screenshot of some of the companies coming through the screener after we sorted by industry. We first checked the most promising industries, which we mention right now in this market are semiconductors and software. It's good news already that we see two companies we already own in the semiconductor space coming through the screen. These are Micron and Credo. The third company on the list is SciTime Corporation, and we vaguely remember looking at this company about a year ago, but it's probably worth checking in on them again. Next, the screener returned two names we've never heard of before, DataVault AI and Blaze Holdings. And this is part of the reason we find this screen so promising so far. It returns a few stocks that we already own, but it also finds new names we wouldn't have discovered otherwise. Under the software category, the first company we see is Nebius. They are a company we own briefly, and it's a popular company with a lot of different growth investors. Additionally, we see three companies related to Bitcoin mining on this list called BitMine Immersion Technologies, Cipher Mining, and BitDeer Technologies Group. We see a company called SoundHound AI, which is a company we looked into a couple times before. It's previously been a deeply unprofitable company that we didn't have a lot of interest in. And it still didn't meet my criteria for printing out the transcript when I looked at the analyst estimates. On the bottom of the software list, there's a company called NextTrip, which is a software company we haven't heard of before. And lastly, there's the company SuperMicro, which we discussed in the beginning of the video. And that was really the goal of this screener, was to include SuperMicro and see what other companies show up in this type of screen where we look at analyst estimates that are accelerating. After checking those most promising industries of software and semiconductors, then it makes sense to look at other industries. And in this screenshot, we have a set of industries which can potentially be interesting. On this list of industries is chemicals, communications equipment, consumer finance, diversified telecommunication services, electrical equipment, and electronic equipment, instruments, and components. Chemicals is a pretty unusual industry to see high growth companies show up in. We see the one name listed in the chemicals category through the screener is called Must Grow Biologics Corp. That's a pretty interesting name, and to have biologics in there implies they might have a new process they developed. Our next step here is to take a look at the financials for Must Grow Biologics. Under communication equipment, we see a company called Lamentum Holdings, and it's a company we looked at before that was a promising new idea, but we didn't end up investing there. There's another company here called Ondas Inc. under communication equipment. I'd never heard of that company before, so it made sense to check out how those financials look. In the next industry of diversified telecommunication services, we see a company called AST Space Mobile. This is a company we looked at before and where we consider it mostly a story stock or a pre-revenue stock. And it's much easier for a pre-revenue or story stock to accelerate their revenue fast. This is because they're growing off of a low base. And additionally, if they have a really promising story, they're probably well funded and they can ramp up sales pretty fast. But ideally, we'd like to see a company with more established revenue and financials to back up a compelling story. The results under the electrical equipment section look promising as well. We see a company called EOS Energy Enterprises. We've looked at this company as well, and it sounds like a really promising story, but we're waiting a few quarters to see how those financials develop. We then see two names we have not heard of before, and these are T1 Energy and Energy Vault Holdings. Additionally, there's two companies called Sun Power and FTC Solar, which both sound like solar companies. There's one more company under electrical equipment called Connect M Technology Solutions. It's another company we have not heard of. And we'll be taking a look at the financials for each of these electrical equipment companies and seeing if there's any impressive accelerations there. Let's now take a look at an industry I mentioned we want to avoid, and this is metals and mining. And you can see here the screener found over 10 names in metals and mining to meet our criteria. One side benefit of using stock screeners is you can see which industries are growing. But it's important to understand the reasons behind that growth. In the case of metals and mining, the price of metals went up. Many companies that mine gold also mine copper, and both gold and copper prices have been rising significantly. This gives companies in this industry extra cash. And often bigger companies in metals and mining go on a buying spree when they free up extra capital. So most of the growth here is from the rise in metal prices and the acquisition spree that some of these companies have been on. And one key takeaway here is if we see a new industry coming through the screen with a lot of different names, it's a good idea to figure out why that industry is growing. This can also give us a meta view of the stock market and how certain industries are performing. Let's now talk about that next step of finding a new company to invest in. T1 Energy, with symbol TE, is a company we have not heard of before. And we first check the financials, which just seem okay. There's big accelerations in revenue, but the company's still deeply unprofitable. However, we remember that the screener we used to find this company indicates this company gave strong guidance for the next quarter. When we check the guidance for the next quarter, the numbers are really crazy. Revenue is projected to go up 101% next quarter, and the year-over-year growth rate for revenue is technically above 14,000%. However, the company had a very tiny amount of revenue 1 year ago, and that's why this percentage change is so big. The other item that's really caught our attention is this company is projected to have their first GAAP profitable quarter coming up. These analysts' expectations practically guarantees a good headline for the press release when this company posts results. Yet much of the stock price may depend on the next quarter's guidance. So just because the press release reads good for the current quarter's posted result, the market might be looking at the guidance. And it's always a guessing game if the market will react to the current quarter results or the guides that the company is giving. Even within the same stock on different quarters, sometimes a stock will rally behind the current quarter results. And other times you'll see the market focus in on the guidance for where the stock trades. Let's take a look at the behind the scenes in the Koyfin app. We're taking a look at the financials for the company T1 Energy. When we look at revenue on the timeline for T1, we see that Q3 of 2024 had no revenue at all, but the company lost $28 million in net income during that quarter. So this typically means this is a well-funded idea to be able to spend $28 million and get no revenue back. Or they could just be burning through money really fast. In the next quarter, we see they have $3 million of revenue. That's followed by $54 million in the following quarter, $133 million, and then $211 million of revenue in the latest quarter. Just looking at these financials alone, they seem okay. There's a huge ramp up in revenue, which we always like to see. But on that $211 million of revenue in the latest quarter, the company lost $131 million of net income. And that shows how deeply unprofitable this company was on their most recent posted result. When we look at gross margin in the latest quarter, it was just 10%. And every quarter before it had higher numbers for gross margin, where 3 quarters ago, the company had a 42% gross margin. So there are a few question marks here, and we're kind of on the fence about whether to investigate more just looking at this piece. Since we know this stock screener in particular uses the analyst estimates, we go and check to see what the analysts expect for the next quarter. This is where we see a stunning number projected for next quarter. Revenue by analyst is expected to be $424 million, keeping in mind the previous quarter was $211 million of revenue, so that's up 101% quarter over quarter. And it also compares to just $3 million of revenue in the previous year, which is up over 14,000%. These projected numbers definitely have us interested now to research more. Our next step is to check out how the analyst estimates look over the course of the next 2 years. And we do find a detail here that could be potentially concerning. After the company is projected to get $424 million of revenue next quarter, analysts expect the following quarter after that to be only $259 million of revenue. This would be a quite large sequentially step down, and the stock would definitely fall out of the screener when it looks at analyst estimates. On the other side of the coin, this could again be the analysts being lazy and filling in some existing numbers here. So it's possible the analysts have not caught up with the growth yet. But this does make me wonder why the analysts expect the revenue to drop off so drastically after an overperforming quarter. And that's definitely one of the main questions we'll look to get answered before considering investing here. Another thing to keep in mind is that this estimate of $259 million of revenue 2 quarters from now is really low. So let's say the next quarter of revenue lands at $430 million, and then they guide to get $350 million of revenue on the next quarter. While the revenue quarter over quarter would be down, this still beats the analysts' estimates by a significant amount, and the analysts in turn would be required to revise their models upward. Analysts raising their estimates is often enough to get interest from the market and push the stock price higher. It also makes sense to look at some of the profitability tabs here under the profitability estimates in Koyfin. When we look at GAAP earnings per share, we see that the next quarter is projected to get positive 6 cents of earnings per share. This would be the first quarter where the company makes a profit on a GAAP basis. And again, keeping in mind, this will make for a good headline in the press release when the company announces results. But there is another concern here on this tab as well, and that's that from 2 quarters from now, analysts expect that this company will get negative 7 cents of EPS on a GAAP basis. So the analysts are projecting that after this next big quarter with revenue and earnings, that there's going to be a big step down in revenue and earnings. It's interesting that the analysts also project this company to lose 5 cents per share on the 3 quarters in 2026. However, you do see in 2027 that the analysts expect this to be a profitable company with earning 20 cents per share of GAAP EPS in Q4 of 2027. So at least the company seems on the right track of trending towards profitability at some point. Let's now discuss the next steps for T1 Energy. Now that we have validated the financials look impressive, we print out the most recent earnings transcript for T1 Energy. We underline with a blue pen the important details from the transcript, and we can also take notes in the margin on the transcript. The main positive signs that we want to see are accelerations in financials and a compelling narrative. But we're also underlining concerns and questions we have as well on the transcript. There is also a full video on this channel about analyzing an earnings report if you want more details on that process. Overall, our impression for T1 is that we like the story the company is telling. It's a growing company that is projected to have a huge revenue step up. Our overall evaluation is that this company is good enough for a starter position. But we did have some concerns about that revenue step up. The next quarter is processing through some excess inventory, and we were wondering if this could be just a temporary boost in sales while getting through this inventory. We're also wondering, do the analysts know some details that we missed where revenue drops off big after this quarter? Or have the analysts not updated their estimates yet, and they're using the typical lazy fill-in-the-blanks approach? Now that we have this starter position, we will reevaluate the company after the next earnings report. Let's discuss some conclusions from this video. We discovered a new screen that delivers promising results for finding growth companies. Rather than look at the current quarter posted results, the screener uses analyst expectations. This screener can find promising names such as T1 Energy and SuperMicro. And both of these companies have actually become small starter positions for me recently. However, the results posted from their Q3 actual financials did not look that impressive. Yet when we see where the analysts expect them to go next, it looks very promising. Some final takeaways are to remember that a stock screener never indicates a good company on its own. And we want to keep stock screeners simple. We would rather have a wide screen which includes many names. A wish list screener, where we select everything we could possibly want in a company, will restrict the number of companies coming back too much. And it's good to challenge yourself to learn about a new company without relying on others or seeing what others think first. This eventually builds the skill set to become completely self-sufficient as a growth investor. This concludes the video on our new stock screener. And I'd be interested for your feedback of what you think of this stock screener or the video in general. As a final reminder, this is not investment advice or recommendations to buy stocks. Thank you for listening.